Welcome everybody to our lecture on free cash flows. So the plan for today, we're going to talk about these things called free cash flows. Very quickly speaking, these are the cash flows from the company's operations. So if you're Apple, these are the cash flows that the iPhone business is generating, right? If you're Southwest, these are the cash flows from all of your customers that you're flying all over the country. Okay, so they're from the operations. Why do we need these things? Why do we need free cash flows? Well, we'll talk about the difference between cash versus earnings. We have earnings pretty readily available if you look at accounting statements, but earnings aren't a great measure of cash flows. They include some things we don't care about, and they're missing other things that we do care about. So we need to adjust. We need to adjust the accounting data and get the cash flows. So that's the plan for today. We'll define the free cash flows in a little bit more detail, and we'll walk through the ingredients. We'll see that there's 4 ingredients to calculating the free cash flows. We're going to start with profit. Okay, so we said that earnings are not a great measure of cash flows, but at least that's where we start. It has intuitive appeal. If you're making money, if you're generating more revenues than expenses, then you're making money. You should be getting some cash flow from that. Okay. The fancy word for the profit that we're going to use is called the net operating profit less adjusted taxes. So we said that the free cash flows are from operations. So we're going to use operating profit. We'll talk about why that's different than net income, for example. A net income isn't from your operations. Net income is your profit from the operations minus your interest expense. So we're only focusing on the operations for now. And obviously we're going to adjust for taxes. When you make a lot of money in your operations, you have to pay taxes, and so that's relevant. So we're going to take away taxes. We're going to replace this very general, abstract sounding word, NOPLAT. We're going to replace that with EBIT times 1 minus T. This is a little bit more concrete. You know exactly how to find EBIT times 1 minus T. So we'll walk through that. So that's our profit. That's where we start. Next, we need to make some adjustments to profits because we realize that profits are not cash flows. The first things we're going to do is adjust for non-cash operating expenses. So you've got all these revenues minus expenses. Some of those expenses that show up in your profit aren't cash flows. And so we really shouldn't be taking them out. Profit's going to be subtracting out these expenses, but they're not cash flows. So what we're going to do is we're going to add them back in to our profit in order to get closer to the cash flows. The main examples we'll talk about are depreciation and amortization. These are things that lower your earnings, but they're not cash flows. So we need to adjust for that. The third and fourth bullet points refer to new investments in the company. Okay. So capital expenditures are new investments in fixed assets, things like plants, property, equipment, kind of long-lived assets. And then changes in net working capital are new investments in current assets. So those are more short-term, things like inventory. Why do we need to make this adjustment? Well, your profit is revenues minus expenses. If you invest in new assets, if you're buying new assets, that doesn't show up in your profit right away. It shows up in your profit over a long period of time when you depreciate the asset, for example, or when you generate revenue from those assets. But if you're buying a building, that's a big expense. That's a big cash flow right away. And the expense from that is only going to show up over 20, 30 years, whatever. So there becomes a big divergence between when you spend the money and when it shows up in your earnings. So we need to adjust our earnings for these new investments in order to get at the cash flows themselves. Okay. So we're going to walk through each of these piece by piece. We'll do very simple examples for each of these 4 ingredients just to fix ideas, make sure we understand why these things are important for our cash flows. And then after that, we'll do a bigger example. We'll walk through a balance sheet and an income statement. We'll use all of that data to put together the free cash flows for some example firm. And then we'll wrap up. We have a few concluding thoughts on free cash flows after that. Okay, so what have we been discounting in this class? If you go all the way back to week 1, it's always cash, right? It's always dollars or euros or something. It's money, right? That's what we discount. We don't discount earnings or profits. or anything like that. It's always some kind of cash flow. Maybe it's a coupon, maybe it's a dividend, whatever. They're all cash flows. Economically, cash is what you care about, because cash is what you can turn into whatever you want, right? You can go to the grocery store and buy groceries with cash. You can't go and buy groceries with income, right? No one's going to know what to do with your income statement that you showed to the teller at HEB or whatever. Okay, so we need cash. That's what you need. Cash flows are not earnings, so we need to be able to translate accounting data into the cash flows. We learned again in week 1 that time value of money is very important. It matters whether you get the cash flow today or whether the cash flow shows up in 10 years. The issue is earnings are not very good at reflecting the timing of the cash flows. Okay, so that's this third bullet point here. If you buy a big building, you're paying a lot of money up front, but it's only going to show up in your earnings very gradually over a long period of time, right? So it's going to be completely missing that time value of money aspect that we know is so important. And this is common for almost every big investment project that you're going to take on. You invest a lot up front, and then you get the cash flows in the future. The accounting is going to smooth things out too much to be a good way to make a decision, right? You need more precise information than what the accounting data is going to give you. So the cash flows are high up front, much higher than the negative earnings that you get, but then later things flip and you get more cash flows than you would get from than the earnings would reflect. Okay. Finally, some measures of income, such as net income, are also including interest payments. Okay. What we're interested in is the operations, again, the iPhone business. Interest payments, remember, those are payments to the bank. The bank is an investor in the company. And so cash flows that are going to the investors, that's a totally separate thing from the operations. What we want to do is we want to nail down the operations and the cash flows to the operations, but net income is going to be conflating these cash flows that we're giving back to our investors, and we don't want to do that if we want to value the operations. Okay, so now you may be asking, we've spoken a lot about earnings and why we don't like earnings. Earnings are not a good measure of cash flows. Well, why do we need earnings? Why do we need accounting in the first place? Why can't we just jump to cash flows? Why can't we just forecast cash flows for a project and use that? Why do we have to bother with all this accounting stuff? Well, I mean, one, you may just have accounting. You may have the accounting information and not the cash flows, and you'll need to work with that. More practically, you need to know about your taxes, right? Taxes are cash flows, right? Those are economically meaningful. And in the US and in many other countries, your taxes are based on your income. Okay, so they're based on this accounting data. So therefore, you can't figure out your cash flows unless you go through the accounting. Also, practically, it helps a lot when you're forecasting cash flows to be able to break your forecasts into pieces. So you say, I'm going to generate these revenues. These are going to be the expenses, right? These are my capital expenditures. These are the current assets that I'll need, right? It helps when you're forecasting to break things into smaller pieces like that. And so you can break things down into revenue, cost, et cetera, and then those are accounting items, and you can translate those accounting items into the cash flows. It's a little bit harder to just say, I'm going to get these cash flows and then just know how you're going to get cash flows without walking through the individual pieces. Okay, so we can't get away from accounting. We need to be comfortable with it. These are the highlight. This is the definition of a free cash flow, right? These are the cash flows after you pay taxes generated by the operations of the company. Things like raising new money or things like paying interest to the bank, those are not part of free cash flows. Those are what we would say are financing items. Raising money from your investors or paying money back to your investors, that's all financing. That's not from the operations itself. We are strictly interested in the operations for now. If you recall from our last lecture, we introduced something called the enterprise value. We define that as the value of the company's operations. right? If you sell the line of business for a company, what would you get? You should be able to sell it for the enterprise value. So the enterprise value and free cash flows are intimately connected, right? We discount the free cash flows to get the enterprise value, right? The free cash flows are generated by the operations. The enterprise value is the value of the operations. So if we want to find the enterprise value, we discount the free cash flows. The free cash flows, therefore, are on the left-hand side of the balance sheet, the asset side. We wrote out this equation last time. The enterprise value plus our excess cash is equal to debt and the equity. So the free cash flows are contributing to the value here, the enterprise value, the left-hand side of the balance sheet. What that means is that our investors, the debt and the equity holders, why is debt and equity worth anything? Well, it comes from the operations. The value that the operations are creating is what is used to pay the debt holders and the equity holders, right? That's why our investors value the company at all. Further, the free cash flows, because they're from the operations, they're unaffected by the mix of financing. So again, if you think about Apple and the iPhone business, the value of the iPhone business is what it is. It doesn't depend on whether Apple uses debt or equity to finance it. You're still willing to pay so much for an iPhone, whether it was equity investors who financed the iPhone or whether it was debt investors or some mix of the two, right? For now, we just focus on the operations, and we're going to not care so much about the right-hand side of the balance sheet, the mix of the investors. So how are we going to get to the free cash flows? Well, we're going to follow 3 basic steps. These steps are going to transform the accounting data, the balance sheet data, and the income statement data. They're going to transform that into the cash flows from the operations. The first thing is we're going to start with our operating profit. And again, this makes intuitive sense. If you're getting more revenues and expenses, your cash probably should be going up, right? You're selling more stuff than you're expensing. That's good. However, these measures of profit, operating profit, they include some stuff that we don't care about, and they exclude things that we do care about. So we need to make those 2 adjustments. That's steps 2 and step 3. So step 2 is getting rid of the things that are in profit that we don't care about. Okay, these are non-cash expenses. These are things that are expenses, so they're lowering your profit, but they're not cash flows. So what we're going to do is we're going to add those things back to our profit to get closer to the actual cash flow. Likewise, step 3 reflects the fact that the profit is missing some things that we do care about. In fact, it misses new investments in the company. You need the cash in order to buy a car or to buy inventory. That's a cash flow that we definitely care about, but that's not going to show up in profit. So we need to take that away from our profit to get at the cash flow. This is that idea in a formula. Okay, so we have the free cash flows on the left. That's equal to our net operating profit here. So we start with the operating profit. Just sometimes you'll see that as no plats. It's just net operating profit less adjusted taxes. Okay. So this is the after-tax profit from operations. And it's just from the operations, so it's not about the financing or anything having to do with non-operating assets, right? It's just about the operations. That's the starting point. That's point 1 here. Then we're going to make adjustments. Adjustment 2 was for non-cash expenses, so we're adding those things back to our profit. And then point 3 was about subtracting new investments. So that's this 3rd term here. We're subtracting new investments in our operations from our profit. And so that's it. 3 steps, 3 terms in this equation to get us at the free cash flows. What are some new investments? What are some examples of this? We're going to have 2 things that we're interested in, 2 types of investments in the assets. The first is going to be called capital expenditures. These are investments in long-lived assets. Fixed assets, things that are around for a long time, things like plants, property, and equipment. The other kind of investment in the asset would be increases in net working capital. So net working capital are current items. So current is the opposite of fixed. Fixed is long-term. Current is short-term. It's got a short shelf life, a short, something like inventory, right? Something that you cycle through pretty quickly. That's net working capital. So if you buy a lot of, sweaters, and you're the Gap and you're buying a bunch of sweaters, that's a lot of cash flow that you care about. That's an investment in your business, your investment in your net working capital. Okay, so these are the two that we'll use in this class. Before we get into the details, the nitty-gritty, and walk through some examples, I'll caution that there's not going to be one single formula that gets at the free cash flows for every firm, right? There's just too much variation across industries and across firms to translate the accounting data into cash flows succinctly. For one thing, it's not always easy to separate operating cash flows from like financing cash flows. So one, you could be in the financial industry. If you're a bank, for example, it wouldn't make sense to even draw this line, right? Your operations are financing. You're making loans. That's a kind of financing transaction, but that's a big part of your operations, obviously. So sometimes it's not easy to draw a line between operations and non-operating cash flows. And likewise, sometimes even for a company that is not a financial, it's still hard to draw a line. So the classic example here are leases. So think about if you lease a car. Well, is that a financing item? Because you're borrowing the car, but you're also using it, you're operating it. So is that an operating asset? Is that part of your operations at that exchange? Or would you consider it financing, right? It's this gray area. If you get if you get a car loan and then use that to buy a car, then it's very easy to separate the two. You've got the car, that's an asset, and you've got the car loan, that would be financing. Then you can separate it. But if you're leasing the car, it's not so easy. How would you separate out the lease from the car itself, right? So the point is, there's always these shades of gray. What we're going to do is cover the standard, cover the baseline way to calculate free cash flows, and then as you progress in your career, depending on which industry you go through, you'll recognize that the free cash flows can be calculated in different ways. Sometimes you'll need extra pieces that we're not going to talk about today, just depending on the nature of the business. Okay, so as you go, you can add to it, but we're going to cover the baseline. So that brings us to the ingredients for free cash flows. We talked about this top equation. This is the general equation to find free cash flows. You start with this thing called NOPLAT, net operating profit less adjusted taxes. Then you add non-cash operating expenses, and you subtract off new investments. Okay, we're going to be a little bit more concrete. Okay, so this top equation, this is just generally true. Okay, this isn't very specific. Like you wouldn't know. This doesn't tell you how to calculate the free cash flows for any given firm. It's just very abstract, right? Take all your non-cash operating expenses, whatever those are, all your new investments, whatever those are. Okay, so this is true, but it's abstract. In this class, we're going to be more concrete, and we're going to be using specific items when we're calculating the free cash flows. So our measure of NOPLAT is going to be EBIT times 1 minus T. So this is our earnings before income and before interest and taxes. Earnings before interest and taxes times 1 minus our tax rate. That's NOPLAT. The non-cash operating expense that we're going to focus on is depreciation. We'll talk about amortization too. They're usually linked together, depreciation and amortization. And the new investments that we're going to study are CAPX and increases in net working capital. Okay, so we're going to walk through each of these 4 ingredients in details, do examples for each of them to make sure we're on the same page. Okay, so EBIT is our operating profit. Depreciation and amortization are non-cash expenses. Big picture, what are they doing is they're reflecting the loss and value of stuff, right? So if you buy a car today, you know that the value of that car just falls over time. You know that things are going to break eventually. So to reflect that, the accountants charge depreciation on the car or on the building, right? Things just kind of lose value over time. That's an expense, but it's not a cash flow, right? If you bought a car last year, you kind of know that the car is worth less than it was when you bought it, but you haven't had to write a check or anything because of that depreciation, right? It's just an accounting convention, a useful convention, but it's not a cash flow. Okay, so those are non-cash expenses that we're going to focus on. CAPX is, sometimes I'll write it with an E, sometimes not. You'll see it both ways. Those are new investments in long-lived assets. And increases in net working capital are new investments in short-lived assets. Okay, you'll see me abbreviate that as NWC, net working capital. It's our current assets, current operating assets, minus our current operating liabilities. Okay, so net working capital is here, operating current assets minus operating current liabilities. Now this thing by itself, this first line, that's not what we care about. What we care about are new investments in net working capital. So we care about the second line, the increase in net working capital. To calculate that, you calculate the increase in your operating current assets and you subtract off the increase in your operating current liabilities. This is picking up how much new stuff are you putting into the company, how much new inventory are you buying, for example. All right, so now we're going to walk through each in detail and see some examples. We'll start with EBIT. What is EBIT? So real quick, before I get into the details of EBIT, I'm just going to pull up the whiteboard here on the left, and I'm going to write out our free cash flows equation. This is what we're going to be using for the rest of the class. Right, so I'm just going to keep it here. We'll refer to that. I'm going to go piece by piece. Right now, we're going to talk about EBIT. So we said that the first part of free cash flows are your profits. That's the starting point. Kind of the long way to say that is your net operating profits less your taxes. Right? We take out taxes, but we don't include things that are not from our operations like financing or non-operating assets. For most firms, we're going to use a more concrete number, EBIT. EBIT times 1 minus T. EBIT, that's earnings, E for earnings, before, B for before, interest and taxes, EBIT. Okay. And then T, here that's your tax rate. We use the effective tax rate. So how do you find your tax rate for a company? Well, it's similar to how you would find your own tax rate. You know how much you earned throughout the year, and you know how much you paid in taxes. And so what is your average tax rate? Will be how much did I pay divided by how much did I earn? That would be your average tax rate. We're going to do the same thing with firms. You look at a firm's income statement and you see how much they paid in taxes, and you see what their taxable income is, and that's their tax rate. So a little bit more on EBIT. It may be a while since you've seen an income statement, so I want to walk through this once. The very top of the income statement, what you start with revenue. Sometimes this is called sales, right? This is what you're bringing into the company. People are paying you for your product. That's your revenue. That's the top line. Then we're going to take away from that all of our different types of expenses to get to net income at the very bottom of the income statement. So what are the first things we're going to do? We're going to start with the operating expenses. So things like the cost of goods sold. If you're Apple and you're selling iPhones, this is the cost of making those iPhones, right? All the little pieces and the labor that go into those iPhones, that's cost of goods sold. And then we've got selling general and administrative expenses, so salaries, overhead, things that you have to pay for as part of your operations, but they're not the actual iPhone pieces themselves. Okay, so after you take away your cost of goods sold and your SG&A, you're left with what's called EBITDA. Now this is earnings before interest, taxes, depreciation, and amortization. Right, so EBITDA, it's an acronym for all of these words. Okay, so we've only taken out a little bit. There's still a lot of other stuff. There's the IDA left, right? What are we going to take off next? Well, we're gonna work in. We've got EBITDA. We're going to knock off the DA. We're going to subtract off depreciation and amortization next. So what are we left with then? It's EBIT. We've taken away depreciation and amortization. We've taken away the DA from the EBITDA, so we're just left with EBIT. This is our measure of operating income. The revenues from your operations, you're selling the iPhones, you're getting cash that way, or you're getting profit, you're getting revenue that way. Then we have to take away the expenses from our operations, the cost of the iPhones, the salaries for our management. Then we take away the depreciation and the amortization for our buildings and our factories. Those things are losing value over time. Okay, we're left with EBIT. That's our operating profit. We stopped right before interest. Now, why did we do that? We mentioned this at the very beginning of the lecture. This is a very important point, though. EBIT is trying to get at the operating profit. We're ignoring financing for now. What is interest? Well, interest is cash that we're giving to the bank. Those are our investors, right? That's the right-hand side of the balance sheet. Any cash flow either coming from or going to our investors, that's the right-hand side. That's financing. Right now, we only care about the operations. Okay, so interest is a financing item. It's money paid to our investors. It's not part of our operations. It's not part of the iPhone business. It's just how do we choose to raise money and reward our investors. So that's why we stop at EBIT and we don't go below that. We stop at the operations. We don't go into the financing. Now, to get the tax rate, what do? You look at your taxable income, which is your earnings before taxes. Right? Your taxable income is your earnings before everything else except taxes. And then you figure out your taxes based on your earnings before taxes. The ratio of these two things gives you your tax rate. And so that's what we saw here. The taxes that you pay divided by your taxable income, that's your tax rate. Okay. So that tax rate is going to affect how much we owe on our profit. So we need to figure that out, and that's a function of our our interest. But the operating profit is going to ignore the interest. So let's do an example, very simple example, just to make sure we're comfortable with EBIT. You've got a business on Etsy, right? You've got all these different folks who make crafts and different hobbies, and they sell them online. Etsy is one market for that. You're making face masks, of course. It's 2020. What else would you make? Each face mask is going to cost you $1 in materials. That's your operating expenses. That's your cost of goods sold. And you're going to sell each mask for $10. So that would be your revenue. You're getting $10 per mask. Your cost of making the mask is $1. You're going to sell 1,000 of these masks each year for 2 years. It's a little bit pessimistic. What will be your free cash flows in 2 years? We're going to assume that we have a tax rate of 25%, and we're going to say that all the cash flows arrive at the end of the year. So this is going to be a common, I think this is the assumption we make in the case too. When you're operating a company, you're generating cash flows throughout the year. To simplify, we're usually just going to put all the cash flows at the very end of the year. This is just so that you can discount in even years. You don't have to worry about discounting day by day or month by month or something like that. You don't have to worry about calculating, the time value of money for each month. You just put everything at the end of the year just to simplify things. Okay, so that's what we're doing in this example. So let's set up a table to see our cash flows. We have 2 time periods in this example, time of up to 2 years. We're going to be generating an EBIT, and we're going to use that to figure out our free cash flow. Okay. In this example, what typically happens is if you're running a business, you're not going to make money right away, right? It takes time to generate sales. It takes time to generate expenses. So generally, when we do these problems, at time zero today, you're just starting off in this business. You're just starting off selling face masks. You don't have any profit right away. It takes time to get sales and expenses. So at time zero, you got no earnings, right? You're just starting. And then over the course of the year, what's happening? Well, you're selling 1,000 masks and you're selling them at $10 and your cost is $1. So what would be your EBIT? Well, it'd be the 1,000 masks times how much money are you making per mask. So you're selling them for 10, it costs you 1. So we're up to $9,000 in EBIT. That's over the first year, and then that's the same in year 2. We're just saying that you're doing the same thing in years 1 and year 2. Now we have this tax rate of 25%. How do we use that to get the free cash flow? Well, remember, the free cash flow is not EBIT by itself. That's your profit, but you have to pay taxes on your profit. So what do you get to keep? You only get to keep 75% of your profit, 1 minus your tax rate. So your free cash flow in this very simple example would be the 9,000 times 1 minus your tax rate of 25%. And so that works out to 6,750. And you would do the same thing at time 2. So your free cash flow at time 2 would be 6,750 as well. Right, so that's EBIT. It's just your profit from your operations. In this case, it was a very simple thing. You just had revenue and you had a cost of goods sold. You had the cost per mask was $1 and the revenue per mask was $10. So you just put those two things together to get your EBIT. You didn't have to worry about depreciation or anything else. It's very simple in this case. Now we'll move to the second item, the second ingredient for free cash flows. That's our depreciation here. And when we talk about depreciation, it also makes sense to talk about CAPX at the same time. The reason is CAPX are your long-term assets. Those are the things that you depreciate, right? The car is going to be around for a while, and so you figure that it's losing value over time, so you're kind of slowly depreciating it over time. Right, so depreciation and CAPX are linked together. Depreciation is an example of this non-cash operating expense. This is the very general thing that we care about for getting free cash flows. Depreciation is the concrete thing we're going to look at. Okay, so these are expenses. They're lowering your profit, like we saw here. Right, depreciation and amortization lower your profit. They are reducing your EBIT, but they're not actually a cash flow. What's the idea behind here? Well, when you buy big equipment, building or property or heavy machinery, something like that, you pay a lot of money up front to buy these things, but you don't get the expense right away. In fact, when you buy a car, you don't expense that at all. Even if you pay in cash for everything up front, that's a big cash flow, but there's zero expense, right? You don't charge any expense for that. You spread the expense out over time as the car loses its value. Okay, so that's what depreciation is doing. You're charging depreciation on the asset each year to reflect the fact that it's going to break eventually and it's losing value kind of slowly over time. And exactly how you do that depends on tax laws, but the idea is that you're losing value over time on the asset. Other things such as goodwill, Those things also depreciate, but we call it something different. We call it amortization. It's the same basic idea. You've got some intangible assets, so it's not a building anymore. It's something more intangible, goodwill or whatever. That's going to lose value over time as well, slowly, so we amortize that. But it's the same exact idea as depreciation. So as we said, it's this accounting convention. It's informative because we know that things really do lose value over time. So it's a very useful idea. It's very informative for us, but it's not a cash flow. You never write out a check to someone named depreciation, so it doesn't affect our cash flow at all. That's why we call it the non-cash expense. There's a couple different methods for measuring depreciation. The most common one we're going to use is straight line depreciation. So we'll do an example here, but the idea is that you buy something and you've got some beginning value for the asset. It's whatever you paid for the car. You paid $20,000 for a Civic. The book value is $20,000. And then we're going to reduce that value over time in equal increments. So if you have a $20,000 car and you depreciate it straight line over 10 years, what that means is you're going to be reducing its value on your books by $2,000 per year. You're depreciating it to zero over 10 years. If the starting point was 20 and you're straight line depreciate over 10 years, you've got to go down $2,000 each year. Every year you're taking an expense of $2,000 to bring the total value to zero in year 10. An alternative is accelerated depreciation. So that's exactly as the name implies. You're taking more of a depreciation expense up front. Okay, so it's not in equal increments. You charge off a big piece of it right away, and then later on you charge smaller depreciation expenses for the asset. What are the cash flow consequences of this? Now, we said that depreciation is not a cash flow, but it's still going to affect our cash flows. We have to think about why. So let me pull up this whiteboard again. The key insight is up in this earlier figure here. We walked through the income statement. Where does depreciation show up? Well, it's right here. So it's part of our earnings. It's not a cash flow, but it's part of our earnings. How does it affect our cash flows? So now you have to think all the way back to the very beginning. Why do we care about accounting at all? Why is any of this useful to us? Well, taxes, right? Taxes are a function of our accounting earnings. And if you notice, depreciation is up here. Our taxes are down here. What does that mean? That means that depreciation is affecting our taxable income. So depreciation affects how much we pay in taxes. So therefore, even though depreciation is not a cash flow by itself, it's still having an effect on our cash flows via our taxes. Okay, so let's walk through this very quickly here. We have this equation so far. We have the free cash flow is the EBIT times 1 minus T plus depreciation. That's what we're covering. We're going to recognize that EBIT includes depreciation. So I'm going to rewrite everything just in terms of depreciation. So our free cash flow is our EBITDA minus the DA, right? Minus depreciation. I'm just going to shorthand write depreciation as DP capital N. So this is just reflecting that EBIT takes out depreciation. To get at EBIT, you need to subtract depreciation. So now I'm going to rewrite things in terms of depreciation. So I'm going to pull depreciation out of this parentheses. So we're left with free cash flows is equal to EBITDA times 1 minus T. And then I need to distribute depreciation to this 1 minus T term. So I'm going to subtract off depreciation times 1 minus t, and then I add on that last depreciation here. This last depreciation here corresponds to that last depreciation there. All I did was I pulled out this depreciation times 1 minus t here. Okay, so now we're going to simplify one more time. How can we simplify this? Well, we've got minus depreciation times 1, and we have plus depreciation here. So these things are going to just cancel each other out. We're going to have minus depreciation, plus depreciation. The net effect is 0. So what we're left with is free cash flows is equal to EBITDA times 1 minus t plus depreciation times t. Oops. This minus depreciation here is multiplied by this minus t there. So multiply a negative thing by another negative thing, you get a plus. Okay. And this is how depreciation is going to show up in our cash flows. You multiply depreciation by t. This thing has a fancy name. It's called the depreciation tax shield. By lowering our taxable income, our depreciation is shielding us from taxes. So you lower your taxable income, it's like a tax credit on your when you do your taxes. If you have mortgage interest expense or charitable donations, something like that, you can claim those as deductions, and that reduces your taxable income. Right? So you reduce your taxable income, that helps you. That gives you greater cash flows because you're paying less in taxes. That's the idea here with depreciation. Okay. So depreciation does have an effect on our cash flows, even though it is not a cash flow by itself. Okay, so this slide works out the algebra here. The main thing to remember, and this is something that students are going to miss, is that EBIT includes depreciation and amortization. Right? You're taking it off of the EBITDA to get at EBIT. So that's baked into your EBIT. Okay. All right. Now we're going to move to the third ingredient in our free cash flow equation. We're going to subtract off capital expenditure. Shorthand is CAPX. Now this is the new investment that you're making in fixed assets. So fixed assets are opposite of the current assets. Current assets are short-term stuff. Fixed assets are long-term things. So again, plant, property, equipment is the kind of quintessential example here. We can use the firm's balance sheet and income statement to find CAPX. Usually in this class, I'm just going to give it to you. So in the case study, we just tell you what the CAPX is going to be. And so you don't need to compute it. You could find it from the balance sheet if you wanted to. So if you're not interested in stuff that's not going to be on the test, then you can tune out for now. But if you are interested in the accounting and in figuring out capital expenditures from your balance sheet, this slide shows you how to do it. The balance sheet gives us your gross fixed assets, your gross PP&E. And it also gives you your accumulated depreciation. So we know that these long-term assets depreciate over time. Your gross fixed assets is how much you paid for them initially. But we know that over time they're losing value, and that loss of value gets captured in this accumulated depreciation. So to get your net effect, the value of your assets minus the depreciation, we calculate this net fixed asset. Okay, your net PP&E. This is your gross amount. That's how much you paid for the buildings or your equipment, minus all the depreciation for those buildings and equipment. Right, so that gives you your book value of the item. Right, how much is it worth on your books after all of the depreciation? To get at CAPX, right, that's what we're getting at now. We don't care about these things by themselves. We want to know how much stuff did you buy. That's what CAPX is. How much new stuff did you buy? To calculate that, you get the increase in net fixed assets. Calculate this thing, you get the increase there, and then you add depreciation for that year to get your CAPX. Why do we have to add depreciation? Well, your fixed assets are going down every year simply because of depreciation. As your assets lose value over time as they're depreciating. Your net fixed assets are losing value. They're going down, down, down because of depreciation. So you don't want to include that drop from depreciation. You don't want to think of that as new investments or anything like that, right? So you add back depreciation here to capture how much new equipment did you buy. Okay, but again, this is more accounting than we need in this class, but while we're here, we may as well discuss it. Okay, let's do an example, fixed ideas for CAPEX. We're going to combine CAPEX with depreciation. And we're going to see how it shows up in our cash flows. We're going to see this thing called the depreciation tax shield. Okay. So in this example, you bought a building for $100, and you're going to depreciate it straight line for 4 years. And that's it. You're not actually going to do anything with the building. You're not going to use it to generate revenue. You're not going to have any other expenses. You're not going to put anything in there. Nothing else is changing. It's really just, I'm going to buy a building and sit in it for 4 years. Okay. So this is as simple of an example as I can think of for CAPEX and depreciation. Your tax rate is 30%. We're going to find the free cash flows from this purchase for the next 4 years. Okay, so let's bring up our table. For any of these problems, drawing out kind of a table is a good first step. How many periods do we have? Well, we've got 4 years, but we also have today. Right, something happens today, and then we're asked to find the cash flows over 4 years. So 0 is always today, and then we've got 0, 1, 2, 3, 4. Oops. Okay. We want to walk through this free cash flow equation. So first thing, 1 minus t. Well, to keep things simple, we said that there's no EBIT, right? There's no profit. So there's no revenue or anything from from this building. But we will come back to EBIT. We can't get rid of EBIT exactly. So I'm just going to leave EBIT by itself, and then just to make things super simple, we'll calculate EBIT times 1 minus t next. Okay. I need a couple more rows. Okay, that's going to be enough. All right, so we have EBIT, that's our first line. Then we need depreciation. And then we also need CAPEX. Subtract off CAPEX. We're going to add depreciation. Subtract off CAPEX. Put all these things together, we're going to end up with the free cash flows. All right. So in this example, what's happening at time 0? Well, we said generally we're not going to have any EBIT at time 0. We're definitely not going to have any depreciation at time 0, right? You just bought the thing. You just bought the building today, so you shouldn't depreciate it, right? It takes time for those expenses to accrue. So at the moment you bought it, it's worth exactly what you paid. You wouldn't depreciate that. So no depreciation, that's for sure. And we're not raising any other, we're not generating any sales or having any other expenses. We explicitly said everything else is just nothing. So there's no EBIT going on at time 0, nothing time for EBIT times 1 minus t. What's happening at time 0? Well, all you did was you bought the building today for $100. Now a building, that's a fixed asset. Those things last for a long time. So it would be considered CAPEX. So how much did you pay in CAPEX? $100. You bought the building for $100. That was an outflow. So what's your free cash flow today? Well, your EBIT is 0. You add depreciation, which was 0, and you subtract your CAPEX, which was 100. So your free cash flow is 0 plus 0 minus 100. It's minus 100. Okay. what happens at time 1? Well, you're not buying any more buildings, right? You only bought the building once. You're not buying the building anymore. You're not selling the building anymore. So CAPEX is going to be 0 going forward. So that's pretty easy. What is happening? Well, it says that we are depreciating it straight line over 4 years. So we're going to have a depreciation expense. So how does that look? We bought the building for $100. So if we're going to depreciate it over 4 years, straight line, that means that our depreciation expense is going to be the purchase price divided by 4. This is going to be the expense each year for 4 years. You're just simply going to take the price, divide it by the 4. So 100 divided by 4, we're going to have a $25 depreciation expense every year for 4 years. That's what we mean by straight line depreciation, is you're just cutting the value up into equal pieces so that at the end it's completely depreciated after 4 years. Next, we have depreciation of 25 at time 1, 2, 3, and 4. It takes time to depreciate it, so nothing happens at 0. But after that, we get an equal depreciation until the book value of the asset goes all the way to 0. Right, so we can see that. Let me just add an extra line up at the top here just to fix ideas. Just make sure we're okay with this. So what is the book value of the building? Well, when you bought it, you have a receipt for $100, so that's the initial value. That's all the accountant is doing, is they're taking the receipt, putting it on the books at what you paid for it. So the book value of this building was 100. Then at time 1, the accountant says, well, this building lost some value. How much did it lose? Well, it lost $25 in depreciation. Okay, so the value at time 1 is going to be 75. The value at time 2 is going to be 50, right? You drop off another 25, then it's going to be 25. And then finally, after time 4, the book value of the building is all the way to 0. Okay, so I want to make sure we're okay with this idea. Depreciation is simply reducing the book value of your asset. What else do we have to do to get the free cash flows for this example? Well, it's a depreciation and CAPEX example. We've handled the CAPEX, we've handled depreciation, but what's one thing that we can't forget about? Again, we go up all the way up here. Where's depreciation? Well, it's before EBIT. So it's part of EBIT, right? It's EBITDA minus the DA gives you EBIT. So minus depreciation and amortization is part of our EBIT. So this depreciation expense, what that's doing is that's lowering our EBIT in the future. So actually, when we buy this building, our EBIT is going to go down by 25. Each year, we've got this extra expense from the building that's lowering our profits. That means we're going to have EBIT times 1 minus T to worry about. So our tax rate was given at 30%. That means our EBIT times 1 minus T is minus 25 times 0.7. So that's 17.5. In EBIT, minus 17.5. And that happens every year for those 4 years. Our EBIT times 1 minus T is a negative number. All right, so it looks a little bit hairy here. For such a simple example, we've got to keep track of kind of a lot of things, but the benefit is that all you need to do is get each number down and then you can figure out the free cash flow, right? Every problem is going to stem from this equation. So we just have to make sure we can get each number in that equation, and then we're set. Okay, so you just have to be very systematic about how you approach these problems. Okay. All right, so we have the EBIT times 1 minus T, we have the depreciation, and we have the CAPX. So now we can calculate the free cash flows. We're just going to walk through this equation, again, in a very systematic way. Our EBIT times 1 minus T is negative 17.5 in time 1. And then we're going to add depreciation to that, which is 25. So what does that leave us? That leaves us with 7.5 in free cash flows. And that's the same thing at time 2, 3, and 4. So this is a little bit odd, right? We should pause here and think about what's going on. All you're doing is you're buying a building and you're sitting in it for 4 years. You're not doing anything else, but yet your cash flows still go up in times 1, 2, 3, and 4. What did we call these cash flows? Well, we call those things the depreciation tax shield. You're not doing anything, but that depreciation is lowering your taxes, and that's a cash flow that you care about. Right, so your cash flows are actually going up by 7.5 by the amount of that tax shield. Obviously, the cash flow at time 0 is intuitive, right? You wrote a check to buy the building, so that makes sense. But what's less intuitive are these tax shields that are showing up because of these accounting rules. Okay, so here it is worked out in the slides. The next thing I want to talk about is we're going to modify this example a little bit for sales. What if you sell a fixed asset? So this happens oftentimes at the end of a investment. So let's say you want to buy a car, but let's say you're a rental car company. You buy a car, but you're only going to run it for 5 years. After say 5 years, no one wants to use an old car as a rental, right? It's not going to be reliable for you if you're Hertz or Hertz is bankrupt, but if you're Avis or something or whatever, you know that you're going to buy the car when it's new, and then you're going to sell it at some point in the future. Okay, so that would be called salvage. You're going to buy a fixed asset, and then at some point you're going to salvage it and get some money back out of it. Okay, so that is an important part of your cash flows. Definitely, if you're a rental car company, you want to make sure that you account for those cash flows from the sale of the assets. When you sell an asset, what you're doing is you're cashing out a little bit, right? Instead of putting money into the company, now you're selling some assets, so you're taking money out of the company. So it's like a negative CAPX, right? You buy a building, that's a positive CAPX, it's a negative cash flow. But when you sell that building, it's a positive cash flow to you. You're bringing money back into the company. You can use that to give to your investors. That's a negative CAPX. How much are you going to get when you sell something like this? Well, it depends on the book value of the asset. Right? So that's why it's always important to keep track of the book value like we did in this early example. If Hertz sells the car for more than it's worth on their books, what are they going to have to do? Well, they're going to have to pay taxes, right? You always pay taxes on your accounting gains. So if you're selling something for more than it's worth on your books, you're going to have to pay tax on that. So that gives us this equation. If you sell an asset, the cash from that transaction is going to be the sale price, which makes sense. If you sell a 5-year-old Honda Civic, maybe you get $10,000 for it. That's a sale price. So that's a starting point. But then you have to pay taxes. How do you pay taxes? Well, you pay taxes on any gain. So you sell it for $10,000. If it's on your books for, say, $8,000, then that's a $2,000 accounting profit that you just made. And so you have to pay taxes on that $2,000. How much are you paying in taxes? Well, it's your tax rate, T, which we saw before. You multiply that by the gain. And so this whole thing here is how much taxes you pay. That reduces your cash flows. Now, it could be sometimes you sell things at a loss, and that actually would increase your cash flows. So again, you just walk through this equation. You sell the Honda Civic for $10,000. What if it's worth $12,000 on your books? Well, then the sale price is 10, book value is 12, so that's a negative number here. You're losing kind of accounting money on it. It's not real money, but you're losing accounting profit on the sale. So you have a negative number inside the bracket. We're going to subtract a negative number. So you're going to actually increase your cash flows when you're selling something at a loss. That's what this last sentence here is saying. The free cash flow could be higher than the sale price if you're selling it at a loss. The idea is the exact same as a tax shield, as a depreciation tax shield over here. Depreciation is lowering your earnings, so it's lowering your taxes. Well, if you sell an asset at a loss, you're also lowering your earnings and also lowering your taxes. So that increases your cash flows. So let's modify our example that we have on the whiteboard here. We're going to modify this to see what happens if you sell the building. Okay. So you purchased the building for 100, you depreciated it straight line for 4 years. Okay, so that's perfect. That's exactly what we did here. We got the book value of the building is depreciating over time to 0 at time 4. And nothing else is going on with your revenue. And then we're going to sell the building at time 4 for $75. We still have this tax rate of 30%. So what are the free cash flows from the purchase? Well, these free cash flows are fine. The depreciation tax shields are still there, but we have to have a separate, we have to treat our time 4 capital expenditure differently. So what's happening at time 4? We're selling the asset. If we look at this equation here, so we're going to sell it for 75. That's important. And our tax rate is 30. So we go up to this equation. What's going to be the cash flow effect from that sale? Well, the free cash flow from the sale is going to be the sale price of 75. That makes sense. We start there, but then we have to subtract off taxes that we have to pay on the sale. So our tax rate is 30%. Just walking through this equation, sale price minus T times the sale price minus the book value. So 75 is the sale price. 30 is the tax rate. The sale price is 75 again. And what's the book value for the building now when we sell it at time 4? Well, we already saw that up here. We kept track of the book value. It's very important to keep track of the book value for reasons like this. At time 4, it's worth 0. So we're going to subtract off 0. That means that the cash flow on the sale is going to be 70% of 75. It's going to be 52.5. So one way to think about this is a negative CAPEX because we're selling the building. So we have a negative 52.5 in CAPEX when we sell the building. We're getting this 52.5 from that. We're extracting that from the assets of the firm. So the free cash flows at time 4 is now going to change because we sold the asset. The free cash flow is going to be the minus 17.5, which was EBIT times 1 minus T, plus depreciation. So now we're up to 7.5, and then minus a negative 52.5. Okay, so it's going to work out to be $60 in free cash flows. Okay, so let me just walk through that piece by piece. What's EBIT times 1 minus T? It's minus 17.5. Then we add the $25 in depreciation. Let's see if I can get a little bit more room here. Yeah, okay. And then we subtract CAPEX, but CAPEX is negative. It's a negative 52.5. So when you subtract a negative number, it's like adding a positive number, right? So what we're left with is a positive $60 in free cash flows at time 4. That's the only place where the free cash flows change in this, this kind of twist on the example when we sell the building. Now you should note that the book value is not always going to be 0 when you sell it. This was a very simple example where we depreciated all the way to 0. But let's just say that this book value was, maybe we only depreciated it, let's say you depreciate it straight line over 5 years, say, instead of 4 years. Well, what would happen to the book value? If you're depreciating it $100 over 5 years, you're depreciating $20 per year. So time 1 would be 80, time 2 would be 60, time 3 would be 40, and then at time 4 it would still be worth $20. So when you sell it, what would be your profit all the way down here? The profit would be the difference between the sale price and the $20 book value. Okay, and so that would be a little bit higher than 52.5 because you're not making as much profit on that sale, so you're not paying as much taxes on that anymore. Okay, so this is just a note. I noticed in past exams, when students see an example like this, they kind of assume that the book value is 0, and they're just going to pay taxes on the sale price, but that's not right. So that's a common mistake, but that's not right. You really have to pay attention to this book value. It could be 0, but it could be more than that. And whatever that is going to show up in the free cash flow from the sale. Okay, so that covers our CAPX and our depreciation and our EBIT. The last piece I want to talk about are increases in your net working capital. We said that these are increases in short-term assets. This part of free cash flow is probably the trickiest. There's a lot going on, but as long as, again, we're very careful and we approach it systematically and just take it piece by piece, I think it is quite manageable. So the issue here with net working capital is that net working capital is net. So it is short-term assets minus short-term liabilities. So why is that? Well, again, we're thinking about investments in short-term current assets. Part of those investments, though, are financed by your liabilities. So one way to think about this is if you have a inventory, you're buying sweaters at the Gap or whatever, that's an investment into your operations, investment in the assets of your operations. One way that you finance those is with, say, accounts payable. When you buy the sweaters and you stick them on your shelves, maybe you don't pay for them right away. You don't pay the supplier of the sweater right away. You wait a little bit to pay the supplier. So that means that you've got the inventory, but you haven't paid for it yet. You're partially financing your inventory by buying the inventory on credit. Okay, so let's go through the equations to try to break that down piece by piece, but that's happening. We've got these differences at work. We've got assets minus liabilities to determine how much you're actually investing into the short-term assets. So what is net working capital? These are your short-term operating assets minus your current operating liabilities. One example of an operating asset that we've talked about is inventory. And one example of a current operating liability we talked about was your accounts payable. So it's the difference here, the net between your short-term assets and your short-term liabilities that determines how much cash you have to put into the business. Again, so a very simple idea, if you buy sweaters, but you don't pay for them yet, because you have this account payable, you owe your supplier money for the sweaters, how much cash have you sunk into the business? Well, zero, right? You increase your inventory, but you've increased how much you owe your supplier for that inventory, and you haven't put any cash into it. Okay, so that would be one kind of simple example where your net working capital would be zero, despite the fact that you've bought a lot of sweaters. Okay. So let's talk about more examples of current assets and current liabilities. Accounts receivable would be one form of a current asset. This is money that people owe you and you expect to receive it in the short term. Right? Inventories is a very nice example. It's something that shows up on your shelves for a little bit, but again, it's very short-lived. Things like prepaid expenses are there as well. If you pay your bills in advance, you pay your utility bill in advance, that's an asset. Things like cash, those will show up on your balance sheet as a current asset, but we are not going to include them generally. Now, why is that? Well, we talked about this with enterprise value. Companies have a lot of cash that is not part of their operations. For free cash flows, we are only interested in the operations of the business. So all that cash that is sitting in Apple's balance sheets, it's sitting in their subsidiary in Ireland, that's not part of the operations, so we shouldn't include it in our current assets. Okay. So unless the cash is explicitly broken out into operating cash, unless you know that it's something that the company is using for their operations, then we're going to exclude it from net working capital. Okay. What are some current liabilities? Well, accounts payable is a big one. That's in our very simple example where you buy some inventory of sweaters. How do you buy them? Well, you have an account payable. You have to pay for them later, right? This is what you owe to your suppliers, maybe your workers. There's payable accounts for wages payable, for example. This is money that you owe. You're going to pay it soon, but you haven't paid it yet. So yeah, accrued salaries would be like a salary payable, taxes payable. These are all current liabilities. Just like we excluded cash because it wasn't about the financing, so too are we going to exclude any kind of financing liability. We're going to exclude things like dividends due or interest payable or short-term debt due or interest payable, anything that has to do with how you raise money or how you return the money to your investors. We're excluding that. Right? We're not touching financing in this lecture. We're only dealing with operations. So that gives us our net working capital. We've got these assets minus your liabilities, all short term. What are the cash flow consequences? Well, if we go back to the whiteboard and look at the free cash flow equation, what affects our free cash flow? It's not net working capital by itself. Rather, it's the increases in net working capital. That's what drives your free cash flows. So why is that? Well, again, it's about how much money are you putting into the business or taking out of the business. If you buy a bunch of sweaters, if you've bought kind of more sweaters than you had before, then you're putting money into the business. If you've increased your inventory, then that requires extra cash. So that would be a cash flow. If you increased your inventory or your accounts receivable, that would be like putting cash into the business. If on the other hand, you bought sweaters, you bought 100 sweaters, but you also sold 100 sweaters so that your inventory stayed the same, then you haven't actually invested any new cash into the business. You bought 100 sweaters and you sold 100 sweaters, so they just net each other out. There's no net cash flow that you are putting in or taking out of the operations of the company. Right? So this is a critical piece. We care about the increases in net working capital, the change in net working capital, not the level itself. We care about how much extra stuff are you putting into the business. You can have an increase in net working capital. That means that you are decreasing the cash, your cash flows if you're buying more sweaters. It can also go in the opposite direction. So if your net working capital decreased, that would be like you're taking money out of the business. So if you have a negative increase, right, you're subtracting the increase. But if you actually had a decrease in net working capital, then this thing would be negative. So the cash flow effect would be positive because you're selling your assets, and that's money that you can then take out of the business. Oftentimes for projects, what we'll have is a big investment in net working capital at the beginning. You have to get the project running. Let's say you buy a big ocean liner that you're going to leave from Galveston Port and go to Europe or something like that. Okay, so you got this big ocean liner. To begin with, you have to invest in all of the gas and the oil and all the supplies that you need, all the short-term supplies that you need to operate the ship. Later on, when you sell the ship down the road, later on what you would do is you would also sell all the oil and all the gas that you have with the ship at that time, right? Like you're not going to sell the ship, but not also sell all the fuel that's in the ship, just as a silly example. So that is called net working capital recovery. When you sell a big asset and you sell all the short-term assets that go along with it, you recover all that stuff, all the stuff that you put into it, and all those short-term assets, you're going to recover that at the end of a project. So again, this is the most difficult part of free cash flows, I think, is dealing with net working capital. Just to show you why that is, we care about these increases in net working capital, but actually net working capital itself is a difference. So what we care about is the difference of a difference, right? So we care about the increase in net working capital. That's what shows up in the free cash flow formula. So that becomes an increase in the current assets minus the increase in the current liabilities. That's what affects your cash flows. So there's a lot going on. Again, as long as we break it up into small pieces, it's very manageable, but it's kind of a lot to look at, and it can give you a little bit of a headache. So let's do an example, try to set ideas, make sure we understand why we only care about the increases, and make sure we can do all of this, this differencing that we need to do here. So in this example, Walmart is going to start selling smartphones. So say it's 2013 or 2014 or something like that. You're just going to build an inventory in this example. And that's basically it. You're going to build up an inventory of smartphones. You don't have any to begin with, so you're going to just buy some. And then all you're going to do is you're going to sell those smartphones at cost. So if we go up to our equation, these are the free cash flows. I'm just going to focus on the increases in net working capital. So when Walmart is buying these smartphones, they're just going to sell them at cost. That means that there's not going to be any EBIT. You're not going to depreciate a smartphone. Those have kind of short shelf lives. And also, there's no CAPEX. You're not buying a building or anything like that. All you're doing in this very simple example is buying some inventory of smartphones and selling them at cost. And so the only thing that's going to affect your free cash flows are your net working capital. Okay, so let's just track the net working capital now. You're going to buy some phones in order to get into the business. So you buy inventory of $1,000. Okay. I'm going to just keep track of this in a little T account. If you're not familiar with T accounts, it's not a big deal. We're just keeping track of how many smartphones do you have on hand. So to begin with, you got $1,000 in this example. Every year, what they're going to do is they're going to sell $800 worth of those phones, $1,000 to begin with. So these are in dollar terms. Every year, they're going to sell 800, and then they're just going to buy another $800 worth of phones to replenish them. Okay. Again, we're selling the phones at cost so that there's no profit effect. EBIT is 0. We can just focus on the net working capital. Okay. So every year they're going to sell $800 in phones, buy $800 of phones. That's going to happen up until time 4. And then Walmart's just going to get out of the smartphone business and liquidate their inventory. Okay, so you can see this is about as trivial of an example as you can think of. They're not making any money. It's just a kind of temporary business. This is going to affect their cash flows, though, and we'll see how. How does this foray affect their cash flows? So we've got the starting balance. They have to put in $1,000. And then every year what they're going to do is they're going to sell 800. So you start at 1,000. You're going to reduce it by 800. Okay, this would be a credit in a T account. All it means is they're selling $800 worth of smartphones. And then they're going to replenish that supply. So during the year, they sell 800 and they buy $800 in new smartphones. So what do they have left at time one? They've been doing this for 1 year now. They started with 1,000, they sold 800, they bought 800, so they're left with 1,000 still. Okay. What's going on with their cash flows? Well, what happened at time 0? They didn't have any smartphones before that, and they decided to get into this business, so they had to buy $1,000. Right, so their net working capital went up. Let's write that. Say the their net working capital went up by $1,000. What is the cash flow effect of that? Well, if you bought $1,000 worth of phones, you had to put that money into the business. So they had to spend $1,000. So the cash flow effect would be negative 1,000. Right? The increase in net working capital was 1,000. So go back to our equation. What's the cash flow effect? If there's an increase in net working capital, it's a negative sign. Right? You're putting money into the business. And so the negative $1,000 is how much cash they're putting into the business. Okay. Now what happens at time 1? Well, they started with $1,000 in smartphones. They ended with $1,000 in smartphones. So how much new business how much new investment did they make into the business? Well, it was 0. They didn't put in any more. They have no more smartphones than they began with. So that's a 0 increase. So what's the cash flow effect? Well, it's negative 0, which is still 0. They didn't put anything new into the business. And this happens every year for 4 years until time 4. Every year they're just buying $800 and selling $800. So what are they left with at time 2? They bought 800, they sold 800. Well, they're still left with 1,000. And likewise, at time 3, they're still left with $1,000 worth of smartphones. So they're not increasing their net working capital at all over time. So they're not deriving any cash flows from this business. Now what happens at time 4? Walmart's going to get out of this smartphone business, and they're just going to liquidate everything. They're going to sell everything they have. So in the past, they would sell 800 and buy 800, but now at the end, they're just going to get rid of it all, and they're going to sell the entire $1,000. And they're out of the business. They don't want to put anything in. So we're going to add $0 to their inventory account. They're just going to sell it all. So what are they left with? At time 4, they're out. They have $0 in smartphones left in this simple example. So now, how does that affect their net working capital? Well, their inventory is a current asset, right? So changes in the inventory drive changes in net working capital. Net working capital started at $1,000 at time 3. It ended at 0. So that means that there was a negative increase. Net working capital went down by 1,000. So it's a negative increase. The cash flow effect is going to be the opposite. It's going to be negative of that, cash flow effect is going to be 1,000. They extracted the $1,000 out of the business when they liquidated everything. Okay. So here's the cash flows. Nothing happens except you put $1,000 in at the beginning, and then you pull $1,000 out at the end. Now, what's confusing here is that there's a lot of churning in between. There's a lot of dollar volume happening between time 0 and time 4, but none of that matters. None of that affected our balance. We didn't have on net any new inventory of smartphones. We had kept that the same. So there's no cash flow effect, even though there's a lot of money changing hands. We're buying and selling $800 worth of smartphones each year. But because we put in 800 and we took out 800, the effect on the cash flows is 0. Okay. We call this thing at the very end net working capital recovery. So they got into the business, and then later when they got out of the business, they sold everything. They reduced their net working capital to 0. That's called net working capital recovery. You get this big cash flow at the very end when you just liquidate everything. A common mistake is to not do all of this differencing, right? So it's tricky to keep track of everything, but we care about increases only. A common mistake would be to just look at this line that I'm highlighting, just the net working capital, which is operating assets minus operating liabilities. That's not the cash flow, right? We saw that from the Walmart example. What was our net working capital each period? Our net working capital was 1,000, 1,000, 1,000, but we saw that those are not cash flows. Okay. And also, the net working capital could be positive or negative, which again is a little bit tricky to think about the first time you see this, but I think this example makes it clear. You buy the smartphones, that's a negative cash flow. You sell them all, that's a positive cash flow. Next, I want to add a little twist to this. So I like doing this. I like having simple examples and then adding one little twist to illustrate a point. Same example with the smartphones, but something's going to happen in the middle. Okay, so I'm going to delete some of these cash flows. Walmart's still going to start with $1,000 worth of smartphone inventory. They didn't have any to begin with. They're going to start with $1,000. We know that that would add an effect on the cash flows of negative 1,000 as you have to buy new stuff. And they're going to start by selling $800 worth of phones, buying $800 worth of phones, and then ending up where they started at $1,000. Okay. Now, why do they need this $1,000 in inventory? Well, why does any retailer need inventory? They want to make sure that the product is there when customers come to buy it. It's expensive for a store if people go to a store and the stuff's not there. Then they may not go there again in the future. And so you need a certain level of inventory in order to make sure that the customers can buy the product when they need it. Suppose Walmart improves their supply chain. This is what supply chain folks are trying to do. They're trying to make things run more efficiently. Walmart is great at that, obviously. That's kind of their business is setting up warehouses to improve their efficiency here. So suppose Walmart does this in this example, so that they only need $300 in inventory at any given time, and this happens in year 2. Okay, so sometime in year 2, they figure out that I don't actually need $1,000 worth of inventory every year. I only need 300. How's that going to affect cash flows? Everything else is going to be the same, but they're going to innovate. They're going to improve their supply chain. Now they need less inventory on hand during year 2. Well, the first year is going to be the same. You buy $1,000 to begin with. You sell $800. You buy $800. You're left with $1,000. Time 2, we know things are going to be different. Time 2, you don't need $1,000 anymore. You only need $300 in smartphones. That's your required inventory. If Walmart is selling $800 and they started with 1,000, how much inventory do they need to put into the business to make sure that they have enough inventory on hand? How much new smartphones do they have to buy? They started at 1,000, they sold 800, they want to end up at 300, so they need to put in $100 worth of smartphones. Okay, so we have 1,000 plus 100 minus 800. That brings us to that desired inventory level of 300. So let's see how this affects cash flows. The company started with $1,000 in smartphones, and they ended with 300. So what happened to their net working capital? Well, it went down. It went down by 700. So what does that do to your cash flow? Basically, they were able to sell smartphones and not replace them. So that ends up increasing the cash flow to the business by 700. Right? You extracted $700 worth of value from the business. What happens next? Well, they're still going to sell $800 worth of phones every year. Get a debit of 800. How much do they need to put in at year 3 in order to make sure they hit the $300 inventory that they need? Well, they still need to put in $800. Right? They start at $300. They sell $800 worth of phones. They need to put in another $800 to stay at $300. So what happens to their net working capital at time 3? Well, there was no increase. They started at $300. They ended at $300. No increase, no cash flow effect. Okay. And then finally, in year 4, they're still going to liquidate everything. So you have 300 to begin with, and you're just going to sell that 300. Or maybe you sell the 800 again. That means you had to put in $500 to end at 0. Okay, so they want to bring everything to 0. So if they're going to sell $800, then they have to put in at least $500 more. So what does that do to your net working capital? Well, you've reduced it by 300 now. Okay, so the cash flow effect is going to be a positive 300 at time 4. So this is going to be a source of value added for supply chain folks. I had an internship at a manufacturing company where, it was a finance role, but we were really doing more supply chain than anything. What you're trying to do is you're trying to make things run a little bit more efficiently so that you can extract cash flows. You can generate cash flows for investors. If you don't need to have as much cash sitting in shelves, sitting in warehouses, that's cash that you can give to your investors, and that's valuable. So that's what happens here. They're able to pull that $700 out earlier because they innovated on their supply chain. In a simple example, the cash flows all sum up, right? You put in $1,000 and then you pull out $1,000 eventually. It's just a question of, do you pull out the $700 earlier by innovating, or do you pull it all out at the end when you wrap up the business? So this the T account is in the notes if you need to review that. What about cash? We don't include cash. We go back to our definitions of net working capital here. We said there's all these current accounts, current assets that we use, and there's all these current liabilities. We exclude cash from the current assets, even though it's going to look very tempting. Cash is going to look like the most important current asset that a lot of companies have. We exclude it. The reason we're doing this, as we mentioned with the enterprise value lecture, is that cash is often not an operating asset. It's usually more of a financing item. So Apple, again, has hundreds of billions of dollars in cash that they don't use in their iPhone business. They made a lot of profit from the iPhone business, and they just kind of kept that profit on their books. Okay, but we don't want to treat that as an operating asset. This can also lead to bad problems with double counting if you include cash. So the thought experiment here is, again, think about Apple. They sell a bunch of iPhones and everyone gives them cash. Okay, so they pay for the iPhones in cash. Right? Well, what happened? Apple made a lot of profit from selling the iPhones, but they also increased their cash balance. So the free cash flows could look like 0. right? If you treated cash as a current asset and your cash account goes up, it looks like you're investing a lot into the business because your cash account went up. So you could almost be confused into thinking that the free cash flows were zero. I've got a ton of profit, but my cash went up, and that negated the profit effect, right? So that's the kind of thing we want to avoid. If you're doing very well, you're making a lot of money, it's going to look like your cash is going up, but that's not really what's going on. You're actually generating a lot of cash flows, a lot of very good cash flows for your investors. The fact that your cash balance goes up is a reflection of that. We don't want to subtract out that increase in the cash balance. So that covers all of the ingredients. Now we've talked about each piece of these of the free cash flow equation. We're going to do one example. We're going to see a full balance sheet and a full income statement, and we're going to put it together and see how we can get the free cash flows from accounting data. We want to use our accounting statements for 3 years, from 2012 to 2014. We're going to use that to calculate the free cash flows for 2013 and 2014. And why do we need 3 years worth of statements to calculate 2 years worth of free cash flows? Well, remember, a few of our free cash flow ingredients need to look at changes over time. And so if you want to get the free cash flow in 2013, you need to know how something's changed from 2012 to 2013. So we need to have more. We need to have one more year of data in order to calculate the free cash flows. Okay. I post the spreadsheets below. It's going to be a lot of data. As long as we approach it systematically, we can get the free cash flows. This last bullet point is going to be important. We need to assume that all cash is excess. Free cash flows are getting the cash flows from the operations. This excess cash, we said, is not part of the operations. So in any kind of problem like this, we need to specify what's going on with cash. Is cash part of the operations or not? For the most part, we're going to assume that it is not, but you may have cases where it is, and then you would include it in the net working capital. Okay. So here's the data. This is the income statement. We said that the top line is revenue or sales. Right? This is how much stuff you're selling and what you're selling it for. So you're bringing in $24.40 in sales in 2012, and then you have expenses below the sales. Okay, so you gradually subtract stuff off: the cost of goods sold, SG&A, then depreciation, then interest expense, interest income, and then we get our net income at the bottom. We need the income statement, and we also need the balance sheet in order to calculate the free cash flows. So here's the balance sheet for 2012, 2013, 2014. We have assets at the top, liabilities at the bottom. The other division is between short-term stuff and long-term stuff. So there's a blank line here separating our current assets. These are things with a short shelf life, and our long-term assets here, PP&E. And likewise on the bottom, we've got current liabilities. These are short-term liabilities, and then we've got long-term debt. Okay, so it's a lot of data, but let's take it one piece at a time. We're going to walk through this formula as carefully as possible to calculate the free cash flows for 2013 and 2014. So where should we start? Well, kind of a natural place is with EBIT. That's the first thing in our equation. How are we going to get the EBIT? Let's do it for 2013. Well, we said that the EBIT is our operating profit. It's our earnings before interest and taxes. We stopped. So in the section on EBIT, we said we start with sales, we subtract our expenses, subtract, and where do we stop? Well, we stop at interest, because interest is a financing item. So you notice that this is earnings before interest and taxes. So we subtract everything before interest. In 2013, what does that mean? Well, we have $2,800 in sales, $220 in cost of goods sold, $542 in SG&A, $78 in depreciation. Then we get interest, so we stop right there, where we don't include interest. Okay, so in 2013, we have the $2,800 in revenue minus the $220 in cost of goods sold, minus the $542 in SG&A, and then minus the $78 in depreciation. That gives us $160. I think these are in millions of units or whatever, but 160 of whatever this is. That's our EBIT. So we can go and just write it in our table up here to help us keep track of that. Okay. While we're doing that, we can do it for 2014 as well. Oh, we've got it all set up already. So we've got $3,000 in sales. We've got $2,143 in cost of goods sold, $580 in SG&A, and then $88 in depreciation. So that gives us $189. Okay. Now, you'll note that EBIT is not in the free cash flow equation by itself. We also need a tax rate. So we need to figure out T, and then we'll be able to put these things together to get EBIT times 1 minus T. So how did we get T? Well, around the same time we covered EBIT, we saw that T is our tax rate, our average tax rate. Well, how do you find your tax rate? It's the taxes that you actually pay divided by your taxable income. That makes sense. That's the same thing we do with our personal taxes. We can do that for 2013 and 2014. You'll see that we get the same answer. How much did we pay in taxes in 2013? Well, we paid 43.4. And what was our taxable income? So another way to say the taxable income is your earnings before taxes. It's your earnings after you've taken out all the expenses that you can. You take out all of those expenses that reduce your taxable income. You're left with just your earnings before taxes. In 2013, that was 124. Like that's your income before everything. That was your income after everything except taxes. It's just before taxes. Everything else is included. So we paid 43.4 in taxes, and we had taxable income of 124. So we get a 35% tax rate. And in fact, if you do this in 2014, you would get the same thing. You would get 56 divided by the 160 is also equal to 35%. All right, so we're being very systematic. We're just going piece by piece. Now we've got EBIT, we've got T. That allows us to find EBIT times 1 minus T. So we have 160 times 1 minus 0.35 for 2013. That works out to 104. That. $160 in 2013 times 1 minus 0.35. That gives us 104. May as well do 2014 while we're here. We had 189 now in EBIT, but again we had that 35% tax rate. So that brings us to 122.85 in our no plat. That was the kind of the odd word for EBIT times 1 minus T, or net operating profit less adjusted taxes. Okay, so we got that taken care of. Let's move on to the next piece of the free cash flow equation. So on an exam, a question like this would be a kind of multiple part question, where the first piece would be figuring out EBIT, then the next piece would be depreciation, then CAPX, right? So the exam would be structured like this to try to help you organize your thoughts, and that's exactly how you should approach these things. Okay, so next line in the equation is depreciation. Okay, well, this is nice and easy because it's given straight on the income statement. We just look in 2013 and we see depreciation here of 78, and we see depreciation here of 88 for 2014. So you don't have to do any calculation. You don't have to think about it at all. It's just right there. So now we've got two pieces down. We're going to need to get CAPEX and increases in net working capital still. But so far, we're halfway there. Going to give us some more rows to work with because we're going to need them. All right. How do we get CAPEX? That's going to be the next piece. Can we get CAPEX from the income statement? No, we're basically done with the income statement. The income statement is great for EBIT and depreciation, but CAPEX and increases in net working capital, those are investments that you're making into the company. These are when you buy assets. That's not reflected in the income statement. Okay, so we're basically done with the income statement. We have to move to the balance sheet. That's what keeps track of our assets. Okay. So here's our balance sheet. A lot going on here. What is CAPEX? So, now this is one part where this is more accounting than we need, but I think it's useful to at least see how to calculate CAPEX from a balance sheet. If you go back to the CAPEX slides, we saw that you can get CAPEX as the increase in net fixed assets plus depreciation. Okay, so you can kind of take my word for it, or you can go back and double check the slides. We want to see how much did our assets increase. And if you're buying your assets, if you're buying new assets, then your assets should be increasing. And we have to add depreciation because what happens to our assets over time is they just fall over time due to depreciation. Your asset value just drops because of depreciation. You don't actually do anything, but your asset values are dropping on your balance sheets. So we need to offset that. How do we do it? We add back the depreciation. Otherwise, it looks like we're selling stuff when we're not. So we want to see, do our assets change after adjusting for the depreciation that's lowering our asset balance? So we look in 2013, we need to see, do our net fixed assets change? Well, where is the net fixed assets in our balance sheet? Here's the assets. Fixed assets are long-term assets, so it's not in the top here. These are all short-term. We've got to be down at the bottom. Where's our net fixed assets? That's right here. This is your net property and equipment. Okay, these are long-lived assets. So we're going to see how that changes. So the CAPEX in 2013 is going to be the increase in net fixed assets from 2012 to 2013. So in 2012, we had 434 worth of stuff. And in 2013, we had 481 worth of stuff. Okay, so the change, it's going to be 481 minus 434. And how much did it increase from that? From 2012 to 2013, it ended at 481. It began at 434. So there was an increase there of about 47. But then we also have to add back depreciation. This 434, the starting balance, it would have dropped just because of depreciation. right? We had depreciation of 78. So this net PP&E should have just dropped by 78, all else equal. The fact that it actually rose to 481 means that we bought more than we actually depreciated. We bought stuff worth 78 to offset this depreciation, but then we also bought an extra, 46, or what did I say? Yeah, an extra 47 on top of that. So that gets us a total CAPEX of 125 for 2013. Okay, so we needed the 2012 data to do that, but we just approached it very systematically. Likewise, we'll do the same thing in 2014. Our net fixed assets in 2014 ended at 515. They started at 481. So that looks like, again, we're buying stuff. If our balance is increasing, we've increased our investment into the company. We bought stuff even more than we depreciated. So we depreciated $88 worth of stuff. Our assets should have fallen by $88. In fact, they rose even more. So that means that the total investment is 88 plus the difference between the net fixed assets. And we get that is 122. Okay. Now, in the case study, in most problems, I'm just going to give you CAPEX, so you don't have to worry about going through all of this accounting. But it's there, and it's useful to know. All right. So that brings us to the last part, the increases in net working capital. And again, this is, I think, the trickiest thing to keep track of because there's a lot of moving pieces. So I'm going to break it down into small pieces. Recall that the net working capital are your current operating assets, let's call it your operating current assets minus your operating current liabilities. And what we care about are the increases in net working capital. That's how much extra money you're putting in. Okay, so that's going to be the increase in your operating current assets minus your increase in operating current liabilities. Okay, so I'm just going to take this piece by piece. First, we're going to sum up the current assets and the current liabilities in each year, and then we're going to calculate the change in net working capital. So I'm going to use a lot of rows just to make it a little bit easier to see. First, we're going to calculate these two things separately. We need to get the change in net working capital, so that means we need to know what's happening in 2012 in order to calculate the change in net working capital in 2013. Okay. So what are our current assets in 2012? Well, we look at the balance sheet. Oh, that looks tempting. We have this line here called total current assets. That's 874. That's a trap. We don't want to use this whole thing. Why? Well, we only care about operations. Everything about free cash flows is about operations. So that means we don't include everything. What do we not include? Well, here we're not going to include cash. Remember our assumption here, all the cash is excess, so it's not used in the operations. So it's almost 867. It's 867 minus 12. That gives us our operating current assets in 2012. We can do the same thing for the liabilities. Okay, we go down to liabilities. Here's a nice kind of tempting line here. Total current liabilities, 590. Again, it's a trap. What do we exclude? We exclude anything that has to do with financing. So anything that says debt or credit, we exclude. It's not part of the operations. That's just how we deal with our investors. So it's almost $590, but it's $590 minus that $40. The other things, the accounts payable and the accounts liabilities, those are part of your operations. Okay, so we're left with $550 in 2012. So that means our net working capital is the difference between these two things. So it's going to be $305. 855 minus 550 gives us our net working capital in 2012. Okay. Now we can do it for 1 year, we can do it for the other 2 years. In 2013, we look at our current assets. Well, we get this 978, okay, that's fine, but we're gonna, again, take out the cash. So we're up to 965 for 2013. What about our current liabilities? Well, we've got 670 in total, and lucky for us, that revolving credit facility went away. So we don't have to worry about taking that out anymore. The only current liabilities that we have are our operating liabilities, so we can keep this full amount of 670. That brings us to the net working capital, which is the difference between these two things. So it's almost 300. It is 295 in 2013. All right. Same deal in 2014. We look at our assets. We get 1094 in assets, but we take out that 31 in cash. So we're left with 1063. On the liability side, all we have are operating liabilities, so we use all of that at 699. Our net working capital is therefore 364 in 2014. That's going to allow us to calculate the increase in net working capital. That's what we care about. We don't care about the net working capital per se. We care about how much extra money do we put into this business. So what was that in 2013? Well, we ended at 295 and we started at 305. So we actually dropped. Our increase in net working capital was a negative number because our net working capital went down. How about 2013 to 2014? Well, now we did get an increase. We went up 69 from 295 to 364. Okay. And that's it. We have all the ingredients now. We had to be very, very careful, but we go up to our formula. Do we have that first piece? Yep, we got the EBIT. I'm just going to make that italic. We get depreciation. That's the second piece of the free cash flow. We got CAPX right here. And then we've got increases in net working capital over here. Make these. Okay. So we can put all this together to get the free cash flows in 2013 and 2014. 2013, it's 104 is EBIT times 1 minus C, plus the 78 in depreciation, minus the 125 in CAPX, and then minus the negative $10 in increases in net working capital for a total of 67. Walk through the formula again in 2014. We have 122.85 in no plat. We have 88 in depreciation, 122 in CAPX, and now we have an increase in our net working capital of 69. So that is reducing our free cash flows for a total of 1985. So that would be the answer to a problem like this. It took us a few minutes, but we just went by it piece by piece, just applied the formula ruthlessly and carefully, and we're able to summarize all that data into our 2 free cash flows. So I'll conclude with just some last thoughts on the free cash flows. So again, we've talked about this over and over again. Free cash flows from the operations. Anything that has to do with financing, we've ignored. When it came to calculating our income, we ignored interest expense. When it came to our net working capital, we excluded anything that had the words interest or dividends, credit, debt, whatever, and we excluded cash from the net working capital. We're just trying to focus on the operations. So the question is, well, does the financing matter? Shouldn't we care about that? This is corporate finance, right? We should care about that. We do, and we will get to it, but we're not there yet. The first thing we have to do is get the operations down. And then in the future in this class, again, over like the next month or two, we'll talk about financing in much more detail, and we'll talk about how financing can add value. Okay, but first things first, we focus on the core operations. We can also reconcile free cash flows with our cash account. So if you're generating cash, that means that your cash account should probably be going up. The cash that you're generating is exceeding what you are putting into the business. So your cash balance should be going up here. Or you can pay that cash out to your investors. So you get this extra cash coming into the company. Either you keep it in your cash account or you can pay it out to your investors. Conversely, if your free cash flow is negative, that means you're spending the money that you have, right? You're investing and spending more money than you're bringing in. So hopefully you have enough cash in your account to allow you to do that. With like VCs and entrepreneurial firms, they talk about runway because they burn a lot of cash, right? They don't generate much cash in the beginning, so their free cash flows are very negative. And so they need to plan for that. They need to make sure that they raise enough money so that they can sustain negative free cash flows for a while. There's a few things that have gone wrong. We've reiterated them. We'll do that one more time here. Depreciation is not a cash flow. It's an expense, but it's not a cash flow. As an expense, it has implications for the cash flows because of taxes, but it's not a cash flow by itself. Remember that capital expenditures are not part of your income. So it doesn't show up in your expenses at all. It's an investment. So we have to treat it separately. We can't just use our income. Don't forget about this after-tax salvage and sale value. So this is a very common thing that you sell assets. And when you sell assets, you have to make sure that you keep close track of the book value of those assets so that you know what the true cash flow from the sale will be. So we did an example like that. So yeah, that means we have to track the book value, which is a little bit annoying, but we're going to do pretty straightforward depreciation in this class. The most difficult are changes in net working capital. Right? There's all of these differences. You've got net working capital is a difference between your current assets and your current liabilities, and we just care about the change in net working capital. So it's a difference of those differences. So it's a lot to keep track of, but if you go back to our example, we just took it one piece at a time, and it was fine. So I encourage you to do that too, and I'll try to help it set up problems like that, on the test so that you can take it in bite-sized pieces. So in sum, we've moved pretty fast, really. We started this class with present value, and we introduced this rule, the NPV rule. It's going to help us to determine whether projects are good or bad. So that's going to be our baseline. That's how we maximize shareholder valuation. We went from very, very simple cash flow problems. We took EBIT by itself, and we took depreciation by itself and with CAPX, and we did a simple example with just net working capital. We did these very kind of bite-sized pieces to see how each of these items affect our cash flows. And then we were able to put it all together into something that looked like a real firm. Now we're talking about all of it in balance sheets and income statements, and we're looking at actual accounting data to figure out cash flows. So now it's looking like corporate finance. That's the punchline. We moved pretty quick, but we've got something that looks like what you would see in corporate. So we still have a lot to do, but yeah, I think it's a good start, and much more to come.